Hello, good afternoon. Welcome to MF Corner on CNBC TV 18. I'm Vinni Motiwala and thank you so much for tuning in. Now, today what we're going to be doing is something very exciting, and this is the first time we're doing it here, is Know Your CIO, where you're investing. What are their thoughts? What are their strategies coming in? And today for that, we have Harsha Upadhyaya, Chief Investment Officer at Kotak Mahindra Asset Management Company, to help us decode some of these winning strategies that they follow in terms of investing in mutual funds, navigating through risk, especially in a volatile market, and a lot more in terms of their strategy. Harsha, thank you so much for joining in with us this afternoon. It's a pleasure having you on the show, and will be interesting to know what your thoughts and strategies are over these years and what do you follow as well. So Harsha, let's get started with it. Firstly, I just want to start by knowing in terms of how would you define your core investment philosophy that is there at Kotak Mahindra AMC, and how has it evolved over the years when you are managing such diverse funds, whether you look at the Flexi Cap Fund, Equity Opportunities Fund, ELSS Fund? So what are the strategies that are there? What is your philosophy that you follow?
Good afternoon, Vinny. As far as our core investment philosophy is concerned, it hasn't changed over a period of time. We have shown a lot of discipline to follow the same investment strategy, investment philosophy over a period of time, all through different market cycles. Our investment philosophy is growth at a reasonable price or reasonable valuations, one can say. Our portfolios will be tilted towards growth stocks, but we don't want to overpay for that growth. So we are always conscious of the valuations at which some of these businesses are being traded in the market, right? And it's also a combination of top-down sectoral overlay supplemented with the bottom-up evaluation of companies within those sectors. So it's a investment philosophy which has worked for us over a period of time, and we are continuing to stick with it.
Absolutely. Keeping the discipline to follow the strategy as well. Conscious in terms of valuation is what you are maintaining as well. Top-down approach also in terms of specifically coming in furthermore in terms of sectors and stocks. Harsha, what are the key factors that you consider while constructing a portfolio, especially given that our Indian market is so dynamic? Then what is it that you should be keeping an eye on? What do you keep an eye out on?
While the overarching philosophy is to look for growth stocks at reasonable valuations, we look at three important factors within that: business, management, and valuations. So BMV investment approach is what we follow. Within business, we try to look for businesses which are scalable in nature, which have proven business models, which have very good competitive advantage, and which are generally are throwing up reasonably a steady stream of cash earnings. In terms of management, we want to be aligned with those managements who care for minority shareholders' interest and who have vision for the company and who have the capability to execute that vision over a period of time. That's what we look for. And in all cases, the final filter will be valuations. And depending on the sector that particular business is operating in, depending on various other factors. Some of them may be absolute, some of them may be relative. We look at a different valuation metric as well before taking the final decision on the investment.
Absolutely. Valuation also is important while in taking in terms of the growth that is there. So that's the strategy they follow. Growth at a reasonable valuation, reasonable price, as well as knowing the business, management, valuations. BMV is what you mentioned as an investment strategy and an approach that comes in from your side as well as the fund side. Could you elaborate a bit more in terms of how would you balance, growth versus value stocks? How do you follow this strategy in your funds?
Vinny, as I said, the strategy itself takes care of that balance because we are not really looking at just the growth stocks at any valuation. Usually, if you are a completely a growth investor, you tend to overlook valuations at certain points of time, which we don't want to do. Similarly, if you are a value investor, you will always be looking for value and you may miss some growth opportunities. So we want to be somewhere in the middle. And this is also less risky in our opinion because India happens to be a growth market and the growth is going to be there over a period of time in our market. And if your portfolio is tilted towards growth and if you have not overpaid for that growth, usually the risks in the portfolio would be a lot lesser, is what we think. And the ups and downs that you face would also be much more manageable. So essentially, we look for compounding characteristics in businesses and essentially growth businesses.
Right. Harsha, is there one golden rule or any rule that you follow for an investor who actually wants to build wealth through mutual funds? What is that one rule they should never forget?
I would probably give three important things that an investor need to remember. Three important tenets of successful investing. One is asset allocation. Second is long-term investing. And third would be regular and disciplined investing. I think if you follow these three tenets, more often than not, you would be successful, is what I think. And every investor should try to keep this in mind. It's easier said than done, but I think this is what is going to help over a period of time.
Absolutely. So allocation, prudent asset allocation, long-term focus, as well as discipline and regular investing, no matter what happens, even in an uncertain time, continue with your SIP. I believe that's what you mean to say as well, right? Because people get worried, and that risk is something that scares people, right?
That's exactly what I wanted to say. I mean, SIPs are meant to take care of those volatile periods. And if there are no volatile periods and if it's a one-way market, obviously you will be building your portfolio when the market valuations are moving up or when the prices are moving up. That may not be an ideal situation. You also need volatility to make sure that your average cost comes down for the long-term investments that you're making. So to that extent, discipline and regular investing is very important, and also to have that long-term focus is critical.
Absolutely. Harsha, like I'm saying that, risk overall, even in a portfolio, whenever you see higher risks, sometimes that scares, especially newer investors, right? So as a risk management, just to understand from your point of view, how do you all manage risk? What is it, that you would tell an investor that would give them peace while managing this risk? What is it that you follow as a strategy?
For us, risk management is not a one-off activity. It's a continuous process. And we want to manage all kinds of risk as much as possible. And it's core of our investment philosophy as well. One of the first things that we look at is what kind of business that we are investing in. I mentioned to you in terms of what are the critical things that we evaluate when we are investing. We will never invest in any stock which is not under our internal research coverage. That's the first principle. So we want our research team to evaluate each and every business that we invest into. Later on, we also make sure that we manage funds in a particular way, which reduces the overall risk of the portfolio, given that markets are always uncertain. So we want to keep the portfolios quite diversified, not only from a sectoral perspective, but also from a stock perspective, so that even after doing all of that due diligence, if something goes wrong or if some headwinds come up, then it should not really drive the portfolio down too much. So that's where the portfolio diversification is very, very important. And also we make sure that there is enough liquidity in the businesses that we invest in, because at the end of the day, you can't cross the river and burn the bridge. So you need to be assured that you will be able to exit those positions if something were to go against your hypothesis at any point of time. So these are some of the things that we continuously do and try to keep overall risk in the portfolio at a reasonable level.
Absolutely, Harsha. That surely will be reassuring to hear for investors as well, new mutual fund investors who have come in, that, while there are equity has exposure to risk, there is ups and downs, but when you're investing in a fund, you are surely going to have lesser risk because there are expertised fund managers who are managing the risk as well. But Harsha, there is something that comes in is that retail investors, there are many new ones that have come in, especially post-COVID, right? So for them, if you had to just tell them, as in simplify this complex investment process that is there, everyone wants fast money now. They don't want to wait for a long period of time. How would you tell them to build their trust for a long-term process? How would you explain this to them?
Yeah, you're right. This is the T20 generation rather than a test cricket generation. But investing is never a T20 game. It's always a test cricket in that sense. I think having that patience to remain invested through ups and downs is very, very important. My advice would be again to go back to those three investment mantras that I mentioned. Prudent asset allocation, because if you don't manage your asset allocation well, for example, if you keep chasing an asset class which has done very well or a segment which has done very well, there would be a point where the majority of your investments would be in that particular sector, in that particular asset class, etc. And if there is any headwind that comes up or if there is a concern with that asset class, then a large part of your portfolio would be under risk. So asset allocation is very, very important. The second, I would say, is having that long-term focus. Because what are you doing in equity investing? You are essentially investing in businesses, right? No business can keep giving you profits every day, every month, every year. Right? There will be ups and downs. And that's the reason why we diversify the portfolio as well. So once we have done that, you should not be really looking at a very short term in terms of what's happening to the portfolio. Yes, it is good to monitor the portfolio, but the investment decision should be rational and should be taken with a lot of care with a long-term focus in. And finally, the investment discipline that you need to have. Just like the portfolio managers need to have investment discipline, the retail investors also need to have discipline in terms of staying put with their investments despite volatile times. I think that's what gives you larger wealth creation opportunities over a period of time.
Absolutely, Harsha. Surely noting down all those points, and viewers, you all should also note that down. If you all are investing, while we are a T20 generation, we should maybe start looking more at Test cricket as well. And, long-term investment is the strategy maybe to follow instead of just looking at quick gains. But on that note, viewers, we're going to slip into a very short break. We'll continue this conversation after the break as well. So stay tuned in. Welcome back to MF Corner on CNBC TV 18. Today we have Harsha Upadhyaya of Kotak AMC here to talk to us about their investment strategies. How do they steer through risks? How do they manage the volatile times? And that's what I want to come to, Harsha. Given that, the current scenario, maybe since Jan, we have seen that volatility continue. People always spoke about, should I shut my SIP? Should I close it down right now? Maybe start it at a later time. But when you're managing a fund, how do you keep calm? How do you steer through all of this in terms of volatility? What do you manage? How do you manage?
Vinny, volatility is inherent to equity markets. Anybody who's investing in equity markets should be ready to withstand this volatility for long-term gains. Just like each business faces headwinds and ups and downs, the equity investing also goes through those cycles. And it's not just one business. There are multiple businesses that are there in the portfolio. So to that extent, there will always be volatility that you will see, but you need to manage that. In fact, as a long-term investor, you should be looking for volatility in the market, because that's when irrational decisions are being taken by a lot of market participants. And if you take rational and good decisions at that point of time, that works for you in the long term. So I don't think one should be really worried about volatility, but you should be able to wait through that volatility and use those irrational periods of volatility to actually build portfolio from a long-term perspective. Is what I think.
Harsha, have you made any changes in the recent times? Tariff events, global events that are happening. Is there any way that you have adjusted your portfolio recently?
In fact, most of our portfolios were mostly domestic focused to begin with, since we felt that domestic growth is a lot more resilient compared to global growth. We had tilted our portfolios towards domestic oriented businesses. And the same philosophy has continued a little bit more, even through this tariff uncertainties and the related issues. We believe that our portfolios are quite resilient in the face of what's happening globally. Clearly, there has been a reset in terms of the way that global trade used to take place. We still do not know what is the final form and shape of the negotiations that will take place and where tariffs are going to settle between countries, etc. But I think as far as our portfolio is concerned, most of the businesses are domestic focused and will have very little impact from what's happening in the global trade and commerce.
Right. Harsha, is there a strategy maybe you follow to stay ahead of the curve at such a time? Is there, do you all do something and make adjustments much before anything comes in, or before you start seeing the fall or the volatility start?
That's where we rely on our research team. We are a fundamentally driven investment house, and we keep looking for cues in terms of what's happening in the macro environment, what's happening in each of the industry segments, where are the regulations headed, what are the valuations, and how are the stock prices moving? Is there too much momentum in the market? Is it leading to exuberance, which could lead to correction at a certain point of time, etc. So there are different things that we keep evaluating at all points of time. And as and when we fear that some of our positions would get impacted because of any of those events, then we try to dig deeper and see what could be the corrective actions. And if needed, we start taking those corrective actions. It's not that everything we are able to foresee and we are able to manage, but obviously there is a process which tries to look for some of these anticipated events and their impact, etc. And to an extent, we are able to manage that.
Absolutely. Harsha, is there some limit that you keep, like, or how do you decide when to exit a stock? How do you all also take that call coming in, right? Is it like a percent that I've made so much, now I think I can exit it? What do you all as fund managers also see?
We don't follow a target price, a kind of a rule to really exit a stock. But exiting a stock could be due to any of the factors that I'll mention. One, the company may be doing very well, the stock may be doing very well, but as a proportion in the portfolio, it may have reached a level where you believe that the risks are more, right? For example, if you had taken a position at 2% of the fund, and if you felt that up to 4% is what your risk limit allows, and then as the company starts to do well, as the prices move up, the position may have become more than 4% at one point of time. Then it may be a great company and still doing very well, but from a portfolio perspective, it may not be prudent to keep that at a higher weightage. So you may try to trim that. That's one reason to really look at exiting. The second reason would be that there is a better relative opportunity because the valuations of something that is already in the portfolio has moved up, and you kind of see something better on a relative basis elsewhere in the market. So you try to exit or moderate and get into the other one. The third could be simply you have gone wrong on a particular thesis, and you need to correct that, and you will exit that even without the first two conditions. So it can be any of this.
Absolutely. Thanks for listing that out for us. Harsha, you've spent so much time in this industry as well, different AMCs. You've seen so many cycles come in as well. What has been your biggest lesson as a CIO, maybe handling a fund or even on a personal level?
I think clearly there is no shortcut to success. I think we have to keep working with discipline and make sure that we remain calm whenever there is volatility in the market. It's easier said than done. And that's what finally differentiates some of the investment calls that you take, which sometimes go against you, which sometimes go work for you. But ultimately, I think it's the investment discipline that helps you wade through all of this.
Absolutely. Investment decision and discipline is what makes you pass through your time as well. No shortcuts in success is something that one should follow. Harsha, is there any book that has, enhanced your investment journey or, helped, guided you through the time as well? If there is one, if you could highlight one for us.
I think one of the books, which is a very, very popular book, which also happened to inspire me when I just started my career, was One Upon Wall Street. I think this is a book anybody can read and understand. It's very, very well written and tries to give you how investment should be made, how it should be evaluated, and how it helps you in terms of long-term wealth creation. I think that book, although I read it many decades back, it's something that inspired me in the investment field.
Okay. Is there a typical myth that you have heard about mutual funds that you would like to bust on the channel right now, and you would like to tell the viewers, no, this is not true?
I think one of the myths that are there, that's there in the market, is to look for passive funds in the fear that active funds can underperform. Right. If that is the starting point, I would say that it's a completely wrong starting point, because the passive funds by design will always 100% of the times underperform their respective benchmarks. I don't know how many of those investors have seen this. Every passive fund, whether it's an index fund or an ETF, will always underperform because there is an underlying cost of management, underlying cost of distribution. There are also other costs like impact costs, rebalancing costs, etc. So while it is designed in theory to go in line with the respective benchmarks, it always underperforms. Whereas the active funds can underperform, can also outperform. So if you are going into passive funds, you are actually closing the window of opportunity for positive outperformance. But in case of active funds, at least you are keeping that window open. Whether it happens or not, no one knows. The outcome will only tell you. But at least you are keeping that option.
Okay. Harsha, just the final one coming from me is, if you're investing your money today, top 3 considerations that you would look at while picking a fund.
See, I think clearly the same things that we discussed all through this. I think one has to be really okay with the investment philosophy that a fund house carries forward, right? For example, if you are a very conservative investor and if the fund house philosophy is to invest on momentum, then there will always be a dissonance. So, right. So in that sense, whatever is your investing philosophy, that should be more or less similar to investment philosophy of the fund that you are investing in. Then there will be less dissonance and probably you will continue for a longer period of time. Second is the investment team and the stability and its expertise in the investment field. I think that's very, very important, because all of the decisions that you see in terms of the portfolio construction is being aided by this particular investment team. And if it's a stable team, if it's a coherent team, if it's an experienced team, obviously there are benefits that you gain from that team. And the final thing is what kind of a fund that you want to invest into. The type of the fund, the asset class that you want to invest into. There are different asset classes, there are different funds. Every fund is designed to do a certain thing. It may not be able to do well in every scenario, but there are different funds for different. That's something that you need to keep in mind.
Absolutely. So absolutely, Harsha. 3 rules mainly one should keep an eye out on in terms of the philosophy while picking up their fund as well. But Harsha, thank you so much for joining in with us this afternoon, helping us understand what strategies and philosophies you all follow at the fund as well. Thank you so much for joining in with us. And thank you so much, viewers, for tuning in to MF Corner on CNBC TV 18. Up next, you have Closing Bell, so don't go anywhere.